All right, let's talk about something that's on the mind of pretty much every Canadian business owner. How do you get the equipment you need to actually grow? It's a huge challenge, but you know what? Getting this right is the absolute key to scaling up.
And this is the classic dilemma, isn't it? You know you need that new machine, that new truck, or that new tech to land those bigger jobs. But the thought of tying up all your working capital in one big purchase, well, that can be terrifying. So how do you manage to expand without crippling your cash flow?
So, to help you figure that out, we've put together a pretty clear roadmap. We're going to start with the main challenge, then dive into the 4 main ways you can get funding. After that, we'll pull back the curtain on what lenders are actually looking for, and then walk through the whole process from applying to getting approved. Sound good? Let's get into it.
Okay, so let's get right to the heart of it. The big question is this: how do you get the tools you need to expand your operations and boost your revenue while keeping your business financially healthy and ready for, well, anything? That's the strategic puzzle we're going to solve today.
You know, this quote right here just nails it. This is the whole point of smart financing. It's not about buying something you can't afford, it's a strategic move. You're using someone else's money to fund your growth, so your own cash stays in your business, ready for payroll or a surprise opportunity or those rainy days that always seem to pop up.
All right, so once you decide to finance, you're going to find yourself at a fork in the road. There are basically 4 main paths you can take. Each one is a little different, with its own set of pros and cons. Let's break them all down.
And what I love about this is how it just lays it all out there. You can see the fundamental trade-offs immediately. You're basically choosing between speed, cost, and flexibility. And you'll notice a pattern, right? The fastest options, they tend to have higher interest rates. The absolute cheapest rates, well, those are going to demand a lot more of your time.
So let's talk about specialist lenders. These guys are custom built for small businesses. They just get it. They understand that a landscaping company's cash flow in July is totally different than it is in January. So they can offer things like seasonal payments. And with approval rates hitting almost 90%, they're often one of the most accessible and adaptable choices out there.
Then, of course, you've got the big banks. And let's be clear, they offer the cheapest money. No question about it. But, and this is a big but, you pay for those low rates with your time, a mountain of paperwork, and some incredibly high standards. It's a tough path. In fact, something like 72% of small business loan applications to banks get declined.
Now, leasing, this can be your best friend if you're in an industry where technology is always changing. You know, IT, medical fields, that sort of thing. It lets you use the latest and greatest gear without the risk of owning something that's totally obsolete in a couple of years. Plus, the payments can often be a nice, clean tax write-off.
And finally, we've got the online lenders. Think of these as the sprinters of the finance world. They use tech to give you an answer in hours, not weeks. This is your lifeline when a critical piece of equipment suddenly dies, and every single minute of downtime is costing you money. Yes, you'll pay a premium for that speed, but in an emergency, trust me, it can be worth every penny.
So now that you've seen the options, let's peek behind the curtain. No matter which of those 4 paths you choose, every single lender is trying to get an answer to the same basic questions about your business.
And here it is, broken down. Think of it as 3 pillars. The 2 biggest ones are your credit profile and your cash flow. Each one counts for about 40% of the decision. They're asking, do you have a history of paying your bills on time? And does your business make enough money to handle a new payment? The equipment itself, the collateral, that makes up the last 20%.
This quote really gets right to the heart of it. A strong application isn't just about a great story or your future plans. It's built on cold, hard, verifiable data. Your numbers tell the real story of your business's health and prove you can take on this new debt.
And speaking of numbers, this is a big one, 650. That's usually the minimum personal credit score you'll need to even get in the door at a traditional bank. It's like the first hurdle you have to clear. So it's always a good idea to know your score before you even start applying.
And you know, they really look at 2 sides of the coin. There's your business's track record, how long you've been around, if you're profitable, and then there's your personal financial discipline as the owner. A solid history of on-time personal payments gives them confidence that you'll handle the business debt just as responsibly.
Okay, so you've picked a path, you get what lenders want, and you've got your documents ready. So what does the actual journey look like, from hitting submit on that application to actually getting the funding?
And wow, this timeline makes that trade-off we've been talking about so incredibly clear. On one side, you've got the specialists and online guys who can give you a decision in a day or 2. On the other, the bank, where you could be waiting 4 to 8 weeks. It all comes back to that choice. Do you need speed, or are you chasing the absolute lowest rate? It's really hard to get both. Now, here's a huge pro tip for you. Most delays in getting funded, they're not because the lender's slow. It's because of missing information. So if you want to fly through the process, have these 4 things ready to go before you even apply. A clean quote, your bank statements, your ID, and proof of insurance. Having this stuff ready can honestly turn a week-long wait into a same-day approval.
Now, the world of business financing isn't just sitting still. So let's take a quick peek at a couple of big trends that are already changing how Canadian companies get their equipment.
First up, there's this idea called equipment as a service. Just think of it like Netflix, but for your heavy machinery. Instead of a massive outright purchase, you just pay a subscription to use it. That means all the headaches, maintenance, repairs, it becoming obsolete, that's all on the provider, not you. It's all about flexibility.
And then there's green financing, which is such a win-win. Lenders are actually starting to reward businesses for making environmentally smart choices. So if you finance energy-efficient equipment, you could get better terms, like a lower interest rate. It helps your bottom line, and it helps the planet. What's not to love?
Okay, we've covered a lot of ground. We've talked about the different paths, what lenders are thinking, and even what the future holds. Now for the most important part, bringing it all together so you can make the right call for your business.
At the end of the day, the answer to this question really just depends on what you value most right now in your specific situation. There's no single best option that works for everyone. There's only the best option for you.
So, let's just boil it all down to this. What is your number 1 priority? Is it speed because you need to jump on an opportunity right now? Then look at an online or specialist lender. Is it getting the lowest possible cost to protect your margins? Then you're aiming for a traditional bank, if you can qualify. Or is it flexibility, so you can always have the latest tech? Then leasing is your answer. Just figure out what matters most. And you won't just find a loan, you'll find the right key to unlock the next stage of your company's growth.